From New York City for our viewers worldwide, I'm Sonali Basak, and Bloomberg Real Yield starts right now. Coming up, positive data. Core PCE rises at the smallest pace in 6 months. And volatility hits yields as inflation numbers support bets on Fed cuts. But big picture, there's some relative stability here in the bond market. We begin, though, with the big issue. The case for cuts is getting stronger.
The economy is slowing, and it's slowing faster than most economists expect.
The economy is softening very quickly.
The more important data, it still shows the economy doing well.
I really don't think inflation is going to pick back up.
Generally speaking, the trend in inflation is lower.
I don't see a lot of reason for concern.
If I were them, I would seriously look at July as being a live meeting.
There's enough evidence at this point for the Fed to start cutting.
Fed will be able to cut this year.
Once they start, this is a march. They don't take a step.
Taking control of the Fed is quite difficult.
Let's not forget they're still excessively data dependent.
You can't just be a slave to the high frequency numbers as they come in.
Markets, trying to figure out what the Fed's going to do next.
Now let's look closer at PCE month over month. Of course, it is the Fed's preferred inflation gauge, and it accelerated here in May with the smallest advance in 6 months. And if you look on a 2-decibel basis, just 0.08%. It was actually the least since late 2020. And at the same time, household spending rebounded after a pullback in April, and income showed some solid growth. So even under the surface here, you do have some conflicting data. Yet let's flip up the board here, because even with some moves here in yields, even on an intraday basis today, for example, you do have the move index meaningfully lower than it was late last year and even earlier this year, when you saw data really whipsawing the bond market. And you saw the move index above a 120 handle, even above a 130 handle late last year. You are down now to 95. And the question is, can we stay there? Joining us now is Krishna Memani of Lafayette College, alongside BMO's Earl Davis. And of course, with the slew of economic data that we have so far had, the inflation data, and of course, jobs data ahead. Krishna, where do you see us standing in terms of the Fed's ability to cut? Should they have even cut sooner?
Well, I think we would have all liked them to cut sooner, but the data hadn't been cooperating very much with them. So, and I think while the May numbers are extraordinarily good, I think their verdict is still going to be the fact that, it's one month of good data when you had 4 months of really scary data from their perspective. So I think they are still data dependent. I don't think July is a live meeting. The earliest possibly is in September, and that would require more cooperation from the data and validation of May data than anything else.
When you take the PCE data and the consumer sentiment data that we saw today, Earl, do you think that the data supports a cut yet, or do you think that there's a lot of risks still in the market?
I'll answer that question directly in the end, but I'll start with our base case. Our base case is for no cuts this year, and we actually see a higher percentage of a hike than a cut. Very low, 20% chance of a hike, 10% chance of a cut. Now I'll come back to why that is. There's two distinct playbooks that central banks have in regards to when they cut, when they hike. One is the growth playbook. That's the playbook we saw from basically 2000 to 2020. They ease or hike based upon what growth is doing. The other playbook that they switched to after COVID was the inflation playbook. That's where they hike or ease based off inflation, regardless of what growth is doing. They are distinctly still in that playbook, and we will believe they will stay in that playbook. So that's why we see no cuts as our base case this year, and a higher chance of a hike than an ease. And now I'll answer your question about PCE today. Yes, it's lower, but what we're looking at is wage inflation and services inflation. That's where you're seeing the stickiness. That's where you're seeing that wage price possibility of a spiral happening, and they're feeding upon each other. So PCE, yes, encouraging, gives them a path to possibly cut, but it is not the details that they want to see in regards to what services and wages are doing that I believe is the trigger.
Now, Earl, you are a brave man, certainly floating against the market here. Krishna, I want to hear what you have to say about that, too. What are your ideas around a potential for a hike, actually?
Well, so I understand where Earl is coming from, but I think from my standpoint, it is very unrealistic to expect a further hike given the trend in data that we have seen so far. I think if there was going to be significant reacceleration in the economy, and not just inflation remaining sticky, inflation continue or starting to go up. If that is what was going to happen, you could make a case for rate hikes. I think the right tail of inflation and right tail of higher rates has probably been truncated already. It's never zero, but I wouldn't assign a very high probability to that.
You know, it's interesting. Neil Dutta of Renaissance Macro had told our own Joe Weisenthal and Tracy Alloway here this idea of a potential policy mistake. Here's what he had to say about today's data. Take a listen.
It doesn't really match the tone of the incoming economic information that we're seeing. They're going around telling people that the economy is strong. Over the first 5 months of this year, real consumption is growing below 1%. New home sales, we just learned, are running at their lowest level since last November.
Yeah.
Pending home sales are at fresh record lows. And over the last 6 months, core capital goods orders and shipments are basically flat.
Earl, I hear what you're saying, but what's the risk that the economy starts to weaken a little more than investors currently expect?
I do think it's a real risk, and I do think the economy is slowing as we're seeing. Where the difference come in our view is that they're still in the inflation playbook. Looking at the growth as the trigger is the growth playbook, and they haven't tipped their hat to being in that yet. And there's other things you have to look at as well too. Despite the economy increasing, like financial conditions are still extremely easy, and that is one of the precursors to a pickup in growth again. So I would say there's elements that could charge a pickup in growth again, although it is slowing, and I agree with that. And these are the things we have to be aware of in regards to the tightened labor supply and what we have in the market and the potential for inflation to come back.
Krishna, I want to switch gears here a little bit because, of course, you have the data itself, you have the broader macro, but then you have the presidential election as well. And, of course, we're coming off of a very intense debate with a lot of views coming out of that debate last night. How do you think that the bond market is preparing for the presidential election and the administration that we might or might not see in the next 12 months?
So I think what you are seeing in the market today for 10-year rates kind of gives you a preview of what may come down the road as we get closer to November. It will, at the end of the day, it'll really depend on the policies that get implemented. But it is fair to say, as the markets are telling you today, that if a Trump administration, and if they implement the policies that they are articulating today, which is of significantly higher tariffs, extension of the tax cuts, and continuation of the deficit, that is an outlook for a steepening of the curve significantly. And today may be just the preamble to that. And if this becomes a reality, and if these policies are actually going to get implemented, I think we'll see a lot more of that going forward.
More directly, Earl, who's better for the bond market at this point, President Biden or President Trump?
Yeah, it's a good question. The way we're looking at it, they're both good for the bond market, but they're both good for the economy. Let's start with the economy. And their policies are largely the same: tariffs, deficit spending, even immigration policy. Where the difference is, and this is a big difference, is the deregulatory thrust that Trump will bring into the market. And why that makes a big difference is the companies, individuals that benefit most from deregulation are small and medium-sized companies. They also happen to be the largest employers in the U.S. So they have less cost to apply to regulation and compliance issues. They put that back in the business. That could lead to a super move in the economy from the perspective of tight labor supply. It could reaccelerate inflation. So we think they're both good for 2025, but there is a risk for higher inflation because of increased growth from deregulation that President Trump could bring in.
Okay.
And that's kind of the volatility we're seeing in the bond market.
Okay, quick question for each of you, starting with Earl. Where do you see rates ending 2025, 2-year and 10-year?
2025, big call, 6% U.S. 10-year rates at the end of 2025.
Krishna?
I think, I hope it's not 6%, because if it was 6%, we'll all be the bond buyers who have been in a panic for a long time would be in for a lot more. So I think rates are probably going higher if Trump gets reelected. Whether they get to 6% or not, I don't think that will be the case.
BMO's Earl Davis and Krishna Memani is sticking with us. Hang tight. Up next is the auction block. Foreign-based companies are leading the way this week for U.S. high-grade sales. We'll talk about what's hitting that pipe next. This is Real Yield on Bloomberg. I'm Sonali Basak, and this is Bloomberg Real Yield. It's time now for the auction block. We're going to wrap up the month and the quarter for issuance. In U.S. high grade, there was a foreign flavor to this week's sales. Dollar-denominated Yankee bonds like Vodafone and Nomura driving June sales past $100 billion. And year-to-date sales past $860 billion. It is the second highest amount to start a year on record. And digging deeper, Asia-Pacific dollar bond sales this week tallied around $20 billion, the highest level since January 2023. Companies and governments locking in historically tight spreads before they potentially climb further. And over in U.S. high yield, June was slow. It's been the slowest month this year for issuance. Activity, though, remains well above year earlier levels. Anticipated sales will be relatively slow this summer. And speaking of credit, this week at Bloomberg's Invest Conference, we spoke with some of the biggest names in credit about their outlooks for the rest of this year.
We think there's a big opportunity in credit.
The higher rates is really for longer has catalyzed a lot of things in fixed income.
I just don't see that, the higher for longer, is necessarily going to be the thing that crushes us.
The credit cycle is quite mature. We do expect there to be some challenges ahead.
If you had a turn down in that would affect credit, and that would be a challenge.
We don't think the very record tights that we have on credit spreads are reflective of some of the real challenges we have in the economic backdrop.
We're starting to see not only spreads contracting in the private credit market from mid to high 500s. We hear there's a couple of deals about to get done at 450 over, which is sort of unheard of. But in addition, the documentation terms are starting to also mirror what we see in the public markets. And so the markets are starting to converge.
What's happened is really through 22, 24, or 23, as rates went up, a lot of those companies are gone. They restructured the defaults last year were roughly between high yield and leveraged loans. There was roughly 90 defaults last year. A lot of those companies that existed for too long, they're gone. And so now we're into a new regime where I think we're in a more normalized, what I would call a normalized market.
And joining us now is Yulia Alekseeva of Barings and Krishna Memani of Lafayette College sticking with us. And Krishna, kind of to close out that last segment, we were talking about the potential of the 10-year drifting higher. And what would be the ripple effect about that across credit markets?
Well, so I think that higher trend in 10 years is really going to be accompanied by probably a higher level of nominal growth. So that in itself is probably not a bad outcome for the credit markets, much the way that last few years haven't really been a bad outcome for credit markets either. The challenge there is really going to be with respect to with respect to what the refinancing of the current debt level will end up being. So, if rates don't come back, that is, we reaccelerate because of higher spending, and short rates don't come back, and SOFR remains high, and spreads remain tight, even that is a very untenable situation for a lot of market participants at the moment.
The ultra-low spreads have certainly been a fascination of the market here, Yulia, and there's been a lot of dispersion in terms of what investors think. Will you buy at these valuations? Are you just not getting compensated for the risk you're taking on? Where do you stand in that debate?
Yeah, Sonali, thanks for having me. It's exciting to be here, particularly on a day of very positive macroeconomic releases. Our thesis in investment-grade credit is that we continue to see value. And really the motto of our investing right now is keep calm and carry on. It is true, as you have pointed out, that the spreads are historically tied. But if you think about it from an all-in yield perspective, I would say the yields, the all-in yields, are probably close to the most compelling that I've seen, at least in my career. And so the yield buyer should definitely take advantage of that and enjoy the yields while they last. I will say, in terms of how it translates into our portfolio positioning and just the way we think about risk, is it's important to stay invested. You want to clip the coupon. You want to get that carry. In absolute terms, north of 6% yield is actually quite attractive if you look versus the 15-year history for investment-grade credit. And 2 points that I'll also make is that investment-grade credit is attractive relative to treasuries. The question that I get a lot is, why not just T-bill and chill? And the answer, from my perspective, is particularly for institutional investors with long-term investment horizons, picking up that additional 100 basis points over cash is meaningful. It does compound over time. Let's not forget, compound interest is the eighth wonder of the world, right? It's the people who understand it, earn it, people who don't pay it, and we'd rather be on the earning side of the equation. And the second point I'll make is that investment-grade credit is even attractive relative to high-yield credit. In fact, some of my colleagues and teammates from the high-yield team at Barings have been adding investment-grade credit to their high-yield portfolios more locally because they see the compression between the BBB and the BB rated tranches. So the bottom line is, yes, spreads are tight, but yields are high, and yields are real, no pun intended to the title of this show.
So, Krishna, to that note as well, T-bills, investment-grade credit, or high yields from your perspective? What's a better trade?
Well, so I think I'm more in the T-bill camp rather than investment-grade credit camp. Yeah, I get the point that you're getting a spread, but I think there are plenty of other ways of earning that spread in the short end of the market. And a combination of treasuries and a spread in the short-term market probably gets you better risk reward than just buying a 5-year or 10-year investment credit at this point in the cycle.
Now,
high yield is a little tougher because I think if the environment plays out the way the markets are reacting today, that is, if nominal growth continues to be good and probably reaccelerates, that probably ends up being better for high yield in the sense that a lot of the companies that may have faced defaults may not actually end up defaulting. So from a default adjusted basis, you may get better results than what you would have gotten otherwise.
What does that conversation look like for you, Yulia, when you think about the amount of credit risk investors are willing to take on right now?
Yeah, I think we are in a credit picker's market. Inevitably, the higher for longer has been putting pressure on the margins, on the earnings, on the leverage, on the interest rate coverage, and the rising tide that has been lifting all boats over the last couple of years has been receding. So we are, in fact, expecting dispersion going forward across sectors and across credits in investment-grade credit. What it means for us as active managers is actually a great opportunity. And so to Krishna's point, I think if you find the right spots to play in terms of the capital structure and in terms of positioning on the curve, there's still a lot of value to be extracted. And the way we think about it is a more defensive stance. We think it's important to go to higher ground when there is a lot of uncertainty and instability, particularly with the election around the corner. So we are leaning towards higher quality part of the investment grade universe. Across the backdrop of softening fundamentals and the Fed's focus and really slowing the economy, this seems to be the most natural place to be. And then we are shortening spread duration as a way to mitigate the risk in the face of potentially data that can bring some surprises in the second half of the year. And so our favorite trade right now is being on the front end of the curve, benefiting from that yield inversion while it lasts. And specifically, we like short, high-quality securitized products that offer additional diversification, low correlation to other pockets of fixed income. And interestingly, they also provide a way to get access and direct exposure to U.S. consumer, which has been so resilient and so remarkably strong over the last couple of years.
I'm glad you brought up the consumer, because certainly that's a place that most people people are quite worried about right now. Krishna, are you convinced that the consumer is holding up this strong? Are you seeing any cracks that would give you pause into investing into anything that is very exposed or levered to the consumer?
Well, so I would say that when the income growth is 5-6%, and when the consumer is as delevered as it is, I think of all the things that I need to worry about, probably worries about consumer health, it probably doesn't make the top 5. The point is, post-COVID, the consumer got to a really good situation. Employment is good, income growth is good. That's not the time when consumer blows up.
Our thanks to Krishna Memani of Lafayette and Yulia Alekseeva of Barings. We thank you both so much for your time. Of course, a lot of economic data and still a lot of uncertainty ahead. But for now, still ahead, the final spread, the week ahead. A lot of economic data still ahead of a market holiday, including jobs. Stick with us. This is Real Yield on Bloomberg. I'm Sonali Basak, and this is Bloomberg Real Yield. It's time now for the final spread the week ahead, and even for a holiday week, you have a lot of data coming up. We will get more PMI data and Tuesday JOLTS, plus Fed Chair Powell speaking at the ECB's Central Banking Forum. Wednesday, Fed minutes, plus another round of jobless claims, and U.S. markets, of course, are closed on Thursday for the 4th of July. Friday, the June payrolls report, of course, traders watching closely, both for wages and the inflation report underneath the surface associated with higher wages. For my final thought, a closer look at those jobs estimates. Aside from, of course, wages, we are watching the overall number of non-farm payrolls coming in estimated at 188,000 and much lower than the prior read of 272. Jobless rate expected to be flat at 4%. Average hourly earnings expected to cool. And same goes for year over year to 3.9%. Let's see if that holds strong. And of course, we have a bond market looking a little cooler on the day heading into all that data ahead. So hopefully not too much uncertainty. From New York, that does it from us. Same time, same place next week. This was Bloomberg Real Yield, and this is Bloomberg.